cash out section appears beneath the cash in section, and it also includes most of the same operating expense as you see in Stephen's P&L statement. Advertising, car delivery, accounting and legal, insurance, licenses and fees, equipment repair and supplies, all are tracked here in the same amounts as in the P&L. One big difference in the cash out section, though, is the inclusion of Stephen's owner's draw. This is the amount that Stephen will pull out to quote unquote pay himself every month. Because owner's draw is not a tax deductible expense, this is an item that is not included in the P&L. You'll only find owner's draw on the cash flow spreadsheets. So in the spreadsheet, in Stephen's spreadsheet, because he's decided that he's going to draw $250 a month out of the business every month, we see that as a standard expense in every month of the year all the way across for a $3,000 total owner's draw in the year one of business. The bottom line, or the ending cash of the cash flow statement, is calculated by adding all of the monthly cash in to whatever cash the business had on hand to start the month, and then subtracting all of the expenses or the cash out. In Stephen's case, if we look at the month of January, he had total sales income coming in of $336, another $614 from VR, and if we add those together, that gives him total cash in of $950. We add up the monthly cash out expenses, which included the cost of production, some advertising, car delivery and travel, and accounting and legal expenses, plus his owner's draw of $250, and he had total cash out expenses for the month of January of $864. So $950 of cash in minus the $864 that went out of the business that month to pay for the expenses and the owner's draw gave Stephen ending cash balance of $86. That same ending balance, the $86 ending balance for the year, then, or for the month of January, becomes the starting balance for February. So February, he begins with $86 in the bank account. He pulls in sales income of $500 plus another $100 from VR for total cash in of $600. So his total cash amount in the account in February then is $686. And the process continues from there. So then that's what we'll subtract the February expenses from. And the bottom line, what he's left with in ending cash at the end of February, which in his case is $336, becomes the starting cash balance for March. And it works this way for the rest of the year. One point to make note of, Russell pointed out in his video that funders or state agencies are not going to support businesses that show a cash flow negative amount. So when we look at this ending cash, the bottom line of the business, it's really important that there is always enough money in there to cover all of the expenses and to have a positive ending balance. And the reason that you have to do that is because businesses that cannot stay cash flow positive can't pay their bills. So in Stephen's case, his financials demonstrate that he will be cash flow positive throughout the year. He'll finish the month of January with $86 of cash. That slowly accrues as he has the sales and the VR support all the way through the year, and he ends up with a cash balance of $3,917 in his business bank account. As we said with the profit and loss statements, this is pretty strong for year one, especially when we look at his average monthly expenses, but we do want to see that this too grows over time, because as we look at the ending cash for year two and year three, that's what will begin to give us the information we need to know if his business could respond to a change. So if sales dropped one month, or if a big piece of equipment broke, what we need to know is that he has enough cash in that business account, enough cash on hand to cover any of those kinds of emergencies or contingencies that might crop up along the way.